everyone. Welcome to another edition of Your Wealth Matters. My name is Maria Donas. I'm joined by my colleague, Paul Carter. Welcome, Paul. We are going to be talking through what's been going on over this past quarter, different market updates. So, Paul, it's been pretty wild. There's been a lot going on. We've seen a lot of activity and conflict in the Middle East. We've seen markets moving, bond yields rising. And before we get into specific funds, how do you think about risk right now? And honestly, like what's keeping you up at night?
Yeah, well, it really has been an eventful and nerve-wracking quarter, especially considering the daily developments in the U.S.-Israel war with Iran. What's actually surprised me is how little the broader markets have reacted so far. I mean, we're about 6.5 weeks into this conflict as we're recording this, and the S&P 500 is basically flat to actually a little bit up compared to where it was. Canada is down maybe 1% or so, so not a huge move. Where you are seeing it show up is in commodities.
Right.
Oil is up around 50%, again, depending on when you look at it. And that's really when key risk is I'm focused on right now. If there are meaningful disruptions to oil supply over time, that feeds directly into higher energy prices and then ultimately into inflation. And it's not just oil. Something like 30% of global fertilizer exports move through the Strait of Hormuz, and those prices are already up significantly. When you layer that on top of higher diesel and natural gas costs, you start to see a real risk that food production costs rise meaningfully.
Yeah, we have seen that before, even within the last number of years, right? So we know what that's like.
Yeah, exactly. So, I mean, for me, the big picture is less about markets today, but more about how this potentially feeds into inflation over the next few quarters.
So if inflation does start to move higher from here, what do you think that means for interest rates and especially rates in Canada? Because obviously that matters for those who are looking for income from portfolios. They're looking for, meaningful interest rates.
Yeah, so that's where it's really important for investors. Our view right now is that further rate cuts are probably off the table in both Canada and the US, at least in the near term. If inflation does start to move higher, and we think it could, it makes it very difficult for the Bank of Canada to justify cutting rates. So we think they've likely reached the end of their easing cycle. At the same time, the economy isn't strong enough to suggest rate hikes either. Growth has picked up a bit from the weak fourth quarter, but it's not robust. So what you're left with is a fairly stable rate environment, we think, and that stability is actually a good thing for income-focused investors.
Okay, so stability over higher income, which we all know instability in interest rates causes problems. Right.
Exactly.
How has that interest rate outlook actually shaped what you're doing with your income strategies?
So from a portfolio standpoint, that view has definitely shaped what we did. Our outlook on short-term rates hasn't changed materially, but we've been more cautious on longer-term bonds, where we think yields could remain under some pressure, which is what we've seen so far this year. For instance, the yield curve has steepened over the last year, with bond yields up anywhere from 15 to 35 basis points across the curve. These higher yields push down bond prices. Now, the Universe Bond Index, which is the benchmark that most bond managers benchmark themselves against, is up modestly so far this year, call it 30 or 40 basis points year to date, but it's not doing a whole lot. So in the Capstone fixed income pool, for instance, we've been reducing our exposure to public bonds and leaned more into some of our private credit investments where we think we're seeing better, being better compensated for that risk. And that shift has helped drive stronger returns for us so far this year.
Bonds haven't been doing much this year, and traditionally people think of a classic balanced portfolio as being like a 60-40 portfolio, so that when bonds zig, then equities zag. But if we've seen that relationship break down, and at times it has, right, especially in stressful periods, and for clients who've relied on this type of balanced approach, does it still hold up? And if not, what should they be thinking instead?
Yeah, that's a great question. It's one we get a lot. So if you look over a really long period of time, the 60/40 framework has actually held up quite well. And even this year, it hasn't completely broken down. You've got US equities and bonds roughly flat, and Canadian equities year to date are actually up, largely driven by energy stocks. So I wouldn't say the framework is broken. That said, there have been periods historically when that relationship doesn't work as expected, especially in inflationary environments. So what we think is important is not abandoning 60/40, but complementing it by bringing in other sorts of returns like mortgages, private credit, and other alternative assets. That can help smooth out returns when both stocks and bonds are under pressure at the same time, which has happened in the past and we think potentially could happen again in the future at some point.
Okay, so switching gears a bit, back in October, Capstone, we launched these Christian-based mutual funds, which were really a first in Canada. These options weren't available before to the average Canadian. So now that we've had a few months with them in the market, what has stood out to you so far, and where do you see product innovation going from here?
Yeah, you're right. We're really excited about that launch. We introduced two actively managed mutual funds, one focused on Canadian equities and one on US equities. And each also has an ETF series that trades on the Toronto Stock Exchange. In terms of what surprised me, I'd actually say not too much, and that's a good thing. It's still pretty early days for these funds, and we're very much in the awareness building phase right now. But the feedback we've received has been very positive. There's clearly a segment of investors who want their portfolios to reflect their values, and that's what we're trying to provide. Now, looking ahead, we're definitely thinking about how we expand that line, whether that's into public fixed income or international equities, always with that same faith-based lens. So more to come on that, but I'll say that our clients should expect to hear from Capstone quite a bit in the months ahead.
Good. Well, I'm excited too about those developments. So, just to wrap things up, we know that markets can be emotional. We are emotional. Investors are emotional. So, for someone watching their portfolio right now and feeling the urge to maybe make a change or do something different, what is your advice? And how do you keep emotion from getting in the way of making good decisions?
Yeah, that's always really important, isn't it? Markets do feel a bit volatile right now, but actually in a historical context, it's not that unusual. If you look over the last 50 years, as an example, the US stock market has been down 20% or more from its peak over about 15% of the time. So roughly 1 out of every 6 days of the past 50 years, we've been in an environment where the market is down 20% from its peak. So
20%.
20%.
Okay.
So that's just part of investing.
Mhm.
The key is staying focused on your long-term objectives, why you're invested in the first, or why you've been investing in the first place, and not letting short-term moves drive long-term decisions. And in fact, volatility can actually be helpful. If you are a long-term investor, it gives you the opportunity to rebalance, add into areas that have sold off and trim in areas that have outperformed. So it's really about staying disciplined and not letting emotion take over.
Right. Thank you very much. That has been a great overview of what's been going on here at Capstone and the markets for the last few months. I hope you enjoyed that session. And if you have any feedback or have any specific topics that you hope that we'll cover in a future edition of this series, please let me know. You can reach us at maria@capstoneassets.ca. And for now, we will talk to you soon. Bye.
Thanks very much. Bye now.